Hi everyone, this is Apoorva. I am a managing partner at Stride Ventures, which is a leading venture debt fund in India.
So, Apurva, could you give me like a 1 minute elevator pitch? What is Stride Ventures?
Sure. So Stride is a differentiated venture debt provider to the new age businesses in India. We essentially lend to growth stage companies that are backed by VC and private equity investors. Stride really helps these companies grow and preserve dilution by funding for use cases like working capital, capex, acquisition financing, or proper runway extension in certain cases. Stride, loves to be like a partner to all its entrepreneurs, and we are not just a transactional capital provider. We really help the company navigate a lot of things, whether it's with respect to getting a bank on board, getting in touch with the right kind of capital allocators, customer introductions, enterprise contacts, etc.
Okay. Uh, so you would fall under the category of private debt. What's the right term here?
Yeah, so private credit. So
Private
within
credit.
private
Okay.
credit, there are various verticals. One of that is venture debt.
Okay. Um, Private credit as opposed to why is it called private credit?
So essentially, private credit is credit to the unlisted space,
Okay.
financing solutions to companies which are not listed. And
Okay.
within private credit, of course, there are specialized verticals. So there could be real estate funds, there are infrastructure funds which help you, in so many infrastructure projects. Then you also have performing credit, which can give loans to, say, mid market, SME kind of customers. Structured credit, they'll help you buy out an existing PE or a VC investor and things like that. And then there is venture debt, which is credit to the new age businesses, which are backed by, VC or private equity investors.
What is performing credit? Why is that word performing used there? I just want to understand the
Sure.
broad ecosystem once before going deeper into Stride.
Sure. So the reason it's called performing credit because this is to companies which are profitable. So performing credit, as they call it, is for companies which are generating profit, but they are not the large caps. So they are not companies which are kind of, contacted by all banks and there's easy credit available to them. Because, there's a big market, like banks typically focus on, say, A plus, double A plus kind of clients. And then there is a big space, either rated or unrated, which is not really serviced by the top financial institutions in this country still. But they still need credit, right? They'll have manufacturing facilities, they'll have larger other capex plans or working capital mismatch. So they need credit for that, and which is why this category of performing credit, so to say, in the MSME space, mid market space, but in profitable companies, these companies are not essentially backed by VC or a private equity investor. So these companies could be bootstrapped, where there's a promoter and
Like a
it's
legacy
in the
business.
family or running. Yeah, yeah. So it's like that. Yeah.
Okay, understood. Understood. Something like say you grow. Have you heard of you grow? You grow would be in this space, performing credit. They give loans to businesses, small and mid-sized
So,
businesses.
there could be multiple players. So this can be serviced through an wholesale lending NBFC, but could also be serviced by a AIF, which is Alternate Investment Fund. So these are two formats wherein you can provide credit, but performing credit is the space that largely I spoke about, mid-market kind of companies which are not necessarily backed by PE or VC funds, but are generating some profit, not really bankable, so to say. May be rated, may not be rated. Even if they're rated, they're probably not, near the A region. So that is the segment. There are bunch of wholesale lending NBFCs,
Now,
and there are
one
a
question
lot
here.
of,
Sorry.
yeah.
Before I forget some of the terms that you use, rated, unrated. So this we are talking about being rated by a CRISIL kind of a credit rating
Yeah, by
agency.
one of the rating agencies. Yeah.
Okay. And these rating
Yeah.
agencies give a rating from like say A means good, high quality, and like a D or a E would mean like a risky.
D is junk, but
D
yeah,
is junk.
A
Okay.
within E also is, it's triple A, double A,
Triple A,
A,
double
and then
A. Okay.
there are
Okay.
various
Okay.
shades of B.
Okay.
Yeah,
And now,
and
why use the word wholesale with NBFC? What does that mean?
wholesale is essentially, loans to businesses. There could be retail lending NBFCs also. So retail lending would probably be, say, gold loan to an individual, or a housing loan, or a personal loan to a retail consumer. So all those would be retail NBFCs, but they are wholesale NBFCs. And then there could be AIFs who are, essentially catering to this segment. Within AIFs, there are so many,
What is
structured credit funds.
the implication of being an AIF? What does an so the AIF stands for Alternate Investment Fund. How does that work?
So obviously, NBFCs are regulated by RBI, the Reserve Bank of India. AIF, Alternate Investment Fund, they are regulated by SEBI, right? And AIF is essentially a pooled vehicle. So you raise money from either institutional investors, like you could have insurance companies, uh, pension funds, fund of funds, government of India, banks, and then you also have a lot of family offices, some corporate treasuries, and then you have HNI money also. And typically SEBI has a floor of 1 crore uh, as an investment size, but anybody who can invest more than that, all of that together pooled is a AIF. And then AIF has an investment manager which decides how to allocate these funds. And it's the responsibility of the investment manager to kind of, liquidate those investments and return the money back within the investment horizon as per the return expectations. So with
Okay.
it,
And the way the VC
NBFC
industry
vis-a-vis
works is also through AIFs, right?
AIF,
Like VCs
yes,
are also AIFs essentially. So
yeah,
an AIF
yeah.
can do both debt or equity. I
AIF
mean,
can
they'll
do
have to
both debt
declare
and
it
equity.
before they collect money, that what the AIF is for.
Of course, you file a PPM, which is private placement memorandum, with SEBI, wherein you detail your investment thesis, what kind of exposures you will take, what is your tenor, what is your return expectation, everything.
Okay, understood. Okay. Okay, understood. So performing credit, even a bank giving a loan to a profitable MSME would fall under performing credit. Like loans from banks are also part of this, or
Yeah, you can classify it that as that within banks also you will see that there are verticals called MSME vertical and large cap MNC vertical. So it's that vertical basically.
okay, okay,
But the bank concentration is less. It's significantly underpenetrated in this segment, which is why there are a lot of other formats, so NBFC or AIF, that have to plug this gap.
okay, understood. And you said structured credit.
Yeah. So
What does
structured
that mean?
credit is also, I'd say, probably just a variation to the performing credit. What essentially happens in a structured credit fund, like generally when a bank will give you a loan, or an NBFC, or even for that matter, AIF will give you a loan, it will be within a defined tenor and generally amortizing. There could be some built off moratorium, which is essentially the period during which the principal repayment does not start. So those are more plain vanilla cash flow based kind of lending, right? When I say structured credit, it's essentially that it'll give you something which is not very run of the mill, which means that I might give you a 4-year loan where the first 1.5 years you don't have to pay me anything, and then there is ballooning of my principal, which means that you don't have to start paying equally, but probably I could start with first year being 10% and next year being 40% and the last year being 50%, things like that. Or it could be, for example, folding, basically giving money to a holdco which does not have any cash flow, for essentially buying out the venture capital or private equity shareholder, giving them an exit, which are not necessarily run of the mill kind of lending, because general lending is your regular amortizing cash flow based lending. So that is just structured credit. But yeah, all of structured credit, for example, you will not see NBFCs also giving structured credit, such back ending of principal and all that, right? So it's generally served
So who
best through
gives?
an AIF format. Yeah.
Okay. So there are AIFs which do structured credits.
Yeah,
Okay.
yeah,
Okay.
yeah,
What are some of
yeah.
the AIFs in this structured credit space in India? Any names I would have heard?
Yeah, definitely. So there is Avendus, there
Okay.
is UTI Credit, there is Bearing. Uh, so many of them. Edelweiss. Yeah.
Okay. The investment banks basically they launch these
No,
AIFs for
uh,
structured
n-
credit.
no, not really investment bank. Generally, investment bank is essentially um, anybody who's helping you with, say, a M&A transaction or a listing, IPO, or bond issuances or anything like that. Now, obviously, it makes sense for investment banks to go and diversify and start doing other things, right? So it is more because of that that, say, Avendus started as an investment bank but has XYZ businesses also. Or same thing for probably some other investment bank, but it's not necessary. There could be a pure financial institution doing structured credit with no investment banking desk at all.
Okay. Okay. The advantage of an investment bank is they're the right place. They know people who have money to give. They know people who need money, so they can create a
Yeah, you
AIF
build
to.
your intelligence and network, so definitely
Mhm,
it helps.
mhm,
Yeah.
mhm. Okay, okay, understood. So in the private credit space, there are these specialized loans for, like, say, real estate or infra, and then there are performing, and then there's structured, and then there is venture debt, which
There
is
is
for
venture debt.
startups. Uh,
Yes, yes.
there's also revenue-based financing that falls under the same bucket as venture debt, or that's a separate bucket.
So I want to put that in the same bucket as venture debt because the target segment, because we are here dividing as per the target segment, right? So it is still the new age businesses, largely. But revenue based financing in India is very, very strong, very, very small today. And, I'll just explain the difference between venture debt and RBF, which is revenue based financing. RBF is a very small portion compared to venture debt. RBF is essentially that I give you a loan, a company a loan, and I say that, say 4% of your revenue every month will be given to me. I don't create a charge on your assets or anything, but the payment gateway, I make sure that a certain percentage of your revenue every month directly comes to me. So that is revenue based financing. Generally, the ticket size in RBF is very small, and it will be for companies which are very small, typically, in very early in their journey, and largely consumer names because they'll have that predictability of revenue, and it's easier to underwrite RBF basis predictable revenue streams. Or SaaS revenue streams where there's a certain subscription revenue and you're sure that that is predictable in nature. Venture debt, on the other hand, is a much bigger pie, and for much larger ticket sizes for companies, say between Series A to pre IPO. Like it can cover the entire span of your pre listing journey.
What would be the ticket size for venture debt, like 10 CR to 100 CR, something like that?
Yeah, typically, in venture debt, like the four, five players that are active in venture debt, they'll write you a check anywhere between, say, a half a million to $20 million.
Okay.
And average check size would be probably $3-4 million, but they can landscape your entire journey. Now, increasingly there are certain players, two or three players, with who have recently just come up to even write checks starting from $20 million. So they can write from, say, $20 million to $50 million. So even as obviously things evolve as the industry grows and the startup ecosystem is, say, 15 years old, in India practically, because we keep the starting point as Flipkart. So say 15 years old, so within that venture debt has also evolved. Venture debt is now close to $1 billion of annual deployment, which is quite a
Wow.
lot. It's
Yes.
about 7% of the venture capital deployment every year. Um, and within venture debt now, earlier there were, smaller ticket sizes, and then each of us kind of started increasing the ticket size and being comfortable. Because you have to understand that ticket size is also a function of the fund size, because generally every fund house will say that my maximum exposure in a single company as a percentage of my fund size will be say 5%. So if I'm writing a 100 crore check in a company, I will get limited by that fact that should I have say a 2000 crore fund in order for me to write a 100 crore check. If I have a 1500 crore fund, probably I'll just cap it at 75 crore per deal. So as the asset class evolves, as fundraising becomes slightly easier, I don't think it's ever very easy, but slightly easier, there is acceptance of the asset class amongst your domestic LP base, investor base. You start increasing the fund size, and then you start increasing the ticket size per company. uh, the reason that I said that now there are funds who are writing 20 to $50 million checks also, those kind of funds also have some kind of international backing, so their fund sizes will be a certain size, and then they can also uh, write check sizes starting that 20 million. So now I think venture debt is a fairly evolved space, become really mature in India, and there's acceptance from the LP base, acceptance from the founders, education across the founder base why they should use venture debt, and also with respect to fund managers underwriting the risk, to make sure that a certain return profile is delivered to the investors.
Okay. You use the term landscape, that they landscape your entire journey. What does that term mean?
I just meant that, for example, if today there is a company which is at less than a crore a month, and I have entered with a very small check today in the company, when this company goes and lists, I don't think they need some other player who will be able to take care of their financing requirements better than me, right? So I can start early, and right till the listing point, I'll be able to support with various check sizes, because I'll also keep coming with new funds, and I'll never want a good high quality company to go away from the portfolio. So we'll always try and help the company uh, in their entire growth journey. Of course, they, as the company evolves, probably reaches EBITDA profit, there will be certain banks who can also coexist alongside you, but there'll be always use cases for which venture debt will be better suited in your growth journey.
Okay. I want to ask you a couple of more industry questions before zooming into specifically venture debt and Stride. Uh, you would have heard about the loan that Byju's took from Davidson Kempner. Um,
Yeah.
what kind of loan was that?
So essentially, Byju's took this loan to acquire Akash, right? And it was a TLB loan. Honestly, I also don't know enough about I would say, the nitty gritties of that loan. But yes, when it
That was
was
a
due,
venture debt,
just
or what, like, or was it
yeah,
structured?
you can classify it as, see, you can classify it as venture debt as long as
Okay.
the company is loss making. Byju's is definitely loss making, right? And they still took a call. And I told you,
Okay.
performing credit, it's important that you're profitable. So you would definitely classify it as venture debt. And there could be variations in the term, right? I might be comfortable writing only a 2 to 3 year loan. Somebody can give you a 4 year loan with
Okay.
certain
Uh,
changes in commercials. Yeah.
why is it called term loan B? That TLB. What does that mean? That loan
That is
was
their
called.
terminology.
Okay.
There is no TLB in India, so I'm not
Okay.
really
Okay.
sure
It's a
of
US thing.
the
Got it.
mechanics there.
Okay.
Yes,
Okay.
yes.
Okay. Right. Right. Okay. So they took that debt, and what happened subsequent to that? Why was that debt not fully released to them and all? There was some like
So
complications around that, right?
yeah, and every lender does tranching of the facility, right? That I might give you a sanction of 100 crore, but it is in say three tranches and 25, 25, 50, or whatever. And there are certain milestones that the company has to achieve, certain covenants that the company has to comply with for me to release the subsequent tranches. It's not an obligation on the lender that just because I've sanctioned you, even though I'm seeing that your financial position is deteriorating, you're not complying with those milestones or covenants, I still release that, right? So yeah, so that is probably what
Okay.
happened there.
Okay.
Yeah.
A covenant is like a precondition for releasing the next tranche, like something which the company has to meet.
So covenant, there are two, three kinds of covenants that the company should be in compliance with at all points of time. And all of this is captured in your debt documentation when you sign it prior to taking the money. And the covenants could be financial or general or information in nature. So, financial covenants is essentially that I might say that, your total debt at any point in time cannot exceed XYZ amount. It could be a certain percentage of, your net worth or a certain percentage of your net working capital on your balance sheet. So, there could be debt covenants, or I could also add that, you should have uh, cash runway of at least these many months, which means at any point in time, you should have cash on your balance sheet that should take care of your operational expenses for the next X number of months. Or there could be a covenant with respect to, say, a certain revenue that you definitely should make on a monthly basis. These would be the financial covenants. In information covenants, there could be things like, you have to share your monthly reporting to me by, say, 7th of every subsequent month. You have to share your annual operating plan, which gets decided in your board meeting. Or you have to share, for example, any kind of key management hires or management exits and things like that. Then there are general or restrictive covenants that you cannot hive off any part of your business, or you cannot take more debt without my no objection certificate. Uh, you cannot There cannot be change in management control. You cannot go and sell, say, 90% of the company to somebody else without telling me, right? Because then I'm left with new set of majority shareholders who who I did not take into account while underwriting you. So those kind of things are, the financial covenants. And there could be, then, as I said, milestones. There could be, certain revenue threshold or certain equity raise that the company has to do before drawing down the subsequent tranches.
Okay, understood. Now, tell me how venture debt works. What is the kind of agreement which you would have with a startup, and how does that whole process start?
Sure. So I'll just tell you the entire process and then I can cover what are the documentations involved. So, when should a company take venture debt? A company should take venture debt after they've raised at least 25, 30 crores in equity and they make at least 2 to 3 crore monthly in revenue. And you have some sense of your unit economics, which means that you are positive on a contribution margin level while you be maybe negative on a EBITDA level. And when I say contribution margin, I essentially mean that you should generate enough to take care of cost of goods sold, which is your, before gross margin, your cost of the goods that you're selling. Then the logistics cost, which also includes warehousing, shipping, collections, packaging, all of that. After you deduct that, you generally arrive at CM1, contribution margin 1. That's the industry parlance that you subtract the cost of goods sold, you arrive at gross margin. You subtract the logistics, shipping, packaging, warehousing, SCPW as they call it, shipping, collection, packaging, warehousing. You arrive at CM1. And then you subtract the performance marketing component of your marketing cost, which means anything which is just getting you the clicks and directly resulting in sales, not branding, but just performance marketing. That you subtract, and then you arrive at CM2. And then you have a host of fixed cost overheads and your marketing, brand building stuff, etc., which is fine. So at a CM2 level, you should be break even or generating small profit. That is a good time to take debt. Because if you're taking debt before that, say you're negative gross margin and you've taken debt, it is going to become more of a burden to you than solving anything for you, because everybody should understand that debt as an instrument has to be returned back. You have to return that money. It's your responsibility to return that money. So at no point in time should you over leverage the company and make it so burdensome that there is no way to uh, return that. Also, a good way to think about it is that you are serving a certain cost of debt, right? Whatever it is, it's say 16%. Are you able to use that money to generate better return on capital within the business? And that can happen only once you have that positive unit economics in your business. So that is the right time to think of venture debt. And venture debt is available only to VC or private equity backed companies. That is by design. No venture debt fund will give capital to a bootstrapped company. So that is the filtering criteria, and I'd say starting point for a company to think of venture debt. How much venture debt to take? Because that is also a very crucial thing. You should not take so much debt that it becomes a burden. Debt is a double-edged sword, right? And we always used to call have this phrase, indebted to debt. If you use the debt for right reasons in the right amount of time, it can do wonders in your business, because it has the power to make sure that the business remains yours. You're not diluting your stake. You're using somebody's capital to make sure you're generating a better return from that capital without having to give your shareholding in perpetuity. Right? Once you've diluted equity, you've diluted. You can't get it back. So, how much debt to take? Once you've decided that, okay, I am at that stage where I can think of venture debt, how much debt should you take? A ballpark number is 20% of the equity capital that you've raised, you can take as debt. In your capital structure, you can think of four-fifth part equity and one-fifth part debt in your sources of funds. So if you've raised $10 million, you can probably raise $2 million in equity, in debt. But there are exceptions, Akshay. So if there is a company which is capex intensive, which has its own manufacturing plant, will have its own equipments, then this percentage could be higher, because end of the day there is a hard asset for which you've taken debt. If nothing goes your way, you can say, take this machine, my company is mine. You take this machine, sell it, recover your money. If, for example, similarly, you have a lot of working capital on your balance sheet, there's a lot of inventory receivable from retailers, distributors, enterprise customers, things like that. Then you can say that these are my receivables. You collect it. You take that money and fulfill the debt requirement. So in those cases, the debt percentage could be higher. It should not be very high, but at least a percentage of your fixed asset base or your net working capital base. So if I have 10 rupees in net working capital, okay, I'll take 8 rupees in debt. Even though I had raised, say, 15 rupees in equity, or it's actually 50% of whatever equity I raise, I'm taking in debt. But I have a justification that I have this much working capital, which is giving a cover of, say, 1.2x on the debt that I've taken. Similarly, on the fixed asset base. But if you don't have that much working capital and there is no fixed asset in your business, then as a thumb rule, people use that 20% of whatever equity you've raised should be the debt on your balance sheet.
Okay,
So
let
that's
me.
when should you start and how much? Yeah.
Okay, understood. Let me recap a bit. Uh, so, as a startup, you need to be a funded startup. Though, I wanted to ask you, why not a bootstrapped startup?
So, Akshay, for a venture debt fund also, the fact that they are giving money to a loss making company, you know, is difficult. And for a venture debt fund, it's important that all the companies that I give debt to should give me my money back. I don't have any power law. like a VC fund, right? It's not that two of my good companies are going to take care of eight of my bust companies, right? We have to follow that normal distribution. I keep saying that we don't have any power law curve. Normal distribution where everybody has to land in that, ballpark. So I cannot take that risk of funding a loss making bootstrapped company, because if the company has raised equity, it is definitely couple of things that it gives me. One, that I know, because I don't have the mindset to understand how big is the target addressable market and will this company do well in future and things like that. I may have a view. I will have to have a view as a venture debt provider, and that is a part of the underwriting when we cover it. But I don't think I'm an expert at that. So once there is a validation of a venture capital investor, a good, I would say, institutional, high quality venture capital investor, I know that there is basic level of comfort around the target addressable market, around the pedigree of these people to run this business. The pedigree may be very good, but can have zero relevance in the business that you're doing, right? There has to be some kind of industry insight there. Those kind of things are important. The second is, Akshay, that of course we do our diligence and we do a massive diligence, but the kind of commercial diligence that a VC investor is doing on you to understand, say, the efficacy of your product or customer feedback, I may not be able to do it. So for that as well. And third, I'd say that, I know that so and so VC has invested so much capital in this business. I also know that there is skin in the game from these VC investors, right? And if my debt is so small compared to the equity they've put, that definitely gives me uh, a comfort there. So these are a couple of reasons why.
Okay, understood. Understood. I guess another reason would be that part of your compensation for giving the loan is also equity. So if the company is funded, then you can ascribe a value to that equity.
Absolutely. So, venture debt has two components of return. One is a coupon bearing loan that contributes to a debt IRR. And then we get equity call options in our portfolio companies. And essentially, that means that, say, I have, say, 15-16% on the IRR bit on debt, whatever that number is, between 14 to 16%. My call option gain, I expect that I at least get, say, 4 to 5%, at a fund level. There might be some companies who have no valuation upside, but there'll be some companies who have significant valuation upside. So at a fund level, even if I'm able to make, say, 5 6% additional, and I reach that 20% ballpark in return, that is what I want. Because otherwise, why would I enter this territory of loss making companies?
Okay. The call option is essentially a right to buy the equity at a certain price. Ideally, that price should be below what you feel is the potential price of this company 1 or 2 years down the line.
Yeah, yeah.
Okay.
So there's an exercise price. I have locked in the price, which is the price that you are at today. But I have this option for, say, 7 8 years. Even if 3 4 years later your price has increased by 3x or 4x, I'm still able to buy it at the earlier committed price and then exit at the then prevailing price, book the capital gains that adds those additional percentage points to my return.
Okay, understood. And you could be selling this either in an IPO or in the next round. The investor of the next round could be buying buying the call rights from you.
Yeah.
Okay.
Yeah, so actually, you can sell it to the existing investors, a new incoming investor, to the founder, at listing, before listing, in the secondary market. Yeah.
Okay, understood. Understood. I wanted to so coming back to the recap of when to take debt. So essentially, what you're saying that CM2 should be positive means like the company should have in a way found the product market fit, and
In
the
some
debt
sense,
is
yes.
right. The debt will help them improve. So if they are getting, let's say, a 5% CM2, which is not enough to cover their fixed cost today, but that 5% of a larger base will cover their overheads and make them profitable 1 or 2 years down the line. So that's when you should take debt, when you already have a positive number in the CM2.
Yeah, break even or, you know, positive. Yeah.
Essentially, what you would say, like a growth funding is what venture debt should be used for.
Yes, and you know, although venture debt does not have any end use restriction, we don't ask for any end use certificate, unlike, you know, a bank. But still, when a founder is taking debt, he or she should know what are the reasons for which I'm taking this debt. And typically, when you start thinking about it like that, you will never over leverage yourself. And it's not just the responsibility of the founder, it's also the responsibility of institutions like us. You know, just because a company can take, should we give that money or not? We should also educate the founders that, you know, itna debt is enough for you at this time. Yeah.
Would you be comfortable also funding acquisitions as a venture debt
Yeah, yeah,
company?
yeah. We are
And
fine, Akshay.
what
As I
is
said,
the
we don't
reason
have
for that?
any. So couple of reasons, Akshay. So one, definitely acquisition finance is an end use restriction for banks. They don't fund acquisitions, right? Again, so acquisition is a use case for which you have to go to a, as I said, a wholesale lending NBFC or a AIF. Irrespective of whether it's a startup or not a startup, acquisition financing as a end use, you have to go to alternate sources of financing, not, you know, a bank. Now, with respect to startups in acquisition, right? If, for example, the company itself is loss making, but the company is acquiring a company which has EBITDA profit, right?
Like
That
Byju's and
company,
Nakash.
exactly. So, say for example, that company, I'm just giving you an example, has 10 crores in EBITDA. Typically, you would have, you know, seen, heard that debt to EBITDA of 3x, 4x, depending on the industry, is the comfortable leverage for any financial institution. So, if the company that is getting acquired is profitable, I'll definitely load some debt basis the EBITDA that that company generates to make sure that, you know, I can finance that acquisition through debt. I don't have to dilute my stake. It may be completely debt, or it may be some bit of debt and some bit of equity. It's a mixture of all of that. But yes, it makes sense to fund some acquisitions through debt. A lot of companies have done that. All the Thrasio like models in India, whether it's, say, Mensa, Global Bees, we are there in Mensa. It makes sense to take debt to acquire companies which are profitable, which is what Mensa did. And you know, within, I think it was Asia's fastest unicorn within 6 7 months, because they were able to, you know, build revenue, profitable revenue at a great speed without diluting too much equity, because they use debt smartly to fund those acquisitions.
Wow, amazing. Okay, interesting. All right. So we covered when a company should take debt. What's the next step?
So, you know, you decided that you're taking debt. You also have a ballpark number of how much debt, you know, you want to take. Uh, you approach the venture debt funds. You know, typically good companies, venture debt funds would already have approached you. Uh, but yeah, you have those discussions, and then after a certain level of data sharing, which is generally your, you know, monthly performance, your balance sheet, your shareholding, your investor deck, those are the typical data requirements, post which you can expect a in principle head of terms or a term sheet, indicative term sheet, from the venture debt provider. And there could be 5 6 key items that you should look out for. One, of course, is your coupon, which is your rate of interest, the tenor, what is the tenor of the facility, what is the repayment schedule like, also the warrant percentage, which is the call option percentage, how much call option percentage they are charging. So typically in venture debt, your coupon will be, as I said, anywhere between say 14 to 15%. There could be a small processing fee, which is one time in nature. Then you have warrants, which is generally between 8 to 12%. It could be slightly lower also, but that is the ballpark figure of the debt sanction amount. So if I've given a 10 crore debt, I'll probably have a 1 crore, of equity call option in your company. So that warrant percentage, and then what is the exercise price, as we were discussing, right? What is the valuation for these call options? These are a couple of things that are obviously, commercially important, apart from the amount and your repayment schedule, etc. So once there is alignment on the indicative term sheet, then of course there's some higher level of data sharing. All of this is, any data sharing should be only post the non-disclosure agreement. And once you've shared the data, the venture debt fund will prepare the credit assessment memo, as we generally call it, which is essentially covering all aspects of, uh, say, the founder pedigree, the team, how strong is the team relevant, what are the rounds of equity that the company has raised, how has the valuation for these companies moved, are there strong institutional investors to keep backing them in their future journey, what is the differentiation of the company compared to the incumbents, what is the channel mix, the category mix, what is the traffic on the website, the daily active users, monthly active users, unit economics, then a deep dive on the financial section. Who's your auditor? Is there any qualification? Was there any qualification in the last, say, 2 3 years? Your P&L, balance sheet, cash flow, just doing some stress testing to see that if you're not able to improve your margin, will you still be able to comfortably service this debt? And then obviously, what are the risks that we see? How do we mitigate it? Why are we recommending this transaction? Who have we taken reference checks from? There are a host of audit points also that gets checked. Is there any governance issue, litigation, GST reconciliation, bank statement analysis for revenue cash tie-up, check bouncing, related party transaction? Are you paying your salary on time? Are you paying your provident fund on time for the employees? A host of diligence. And then, of course, we take it to our investment committee. And once that is approved, then, we move to the documentation stage. And in documentation, there are largely, I would say, three agreements which get signed for a venture debt fund. One is your debenture trust deed, which is essentially your facility agreement, which talks about, as we were discussing earlier, of course, it will capture the commercials and repayment schedule and all of that, but it will also cover governance, you know, general information, restrictive financial governance, and what will happen if you breach them, which is a term called event of default, which is discussed at length in these documents. That if a company does not pay on time, or if there is a breach of some of these significant covenants, what is the recourse? And it's not that on day one the lender can, create havoc. There are certain cure periods. That is, a cure period is essentially a time that is given to you to cure the default. How do you correct it? So there might be a temporary blip in my covenant, right? I might breach it for
Give me
15
an
days, but it'll get.
example. Like what could be
So
a
So I'll tell you, for example, if I have asked, the company to maintain a certain months of cash burn, that you should have at least this much cash to fund your operating expenses for, say, XYZ months, and today you are breaching it. But I know that you have already signed a term sheet with an equity investor, and you are expecting that money to come in the next 30 days. The docs are currently in negotiation. As a lender, I will never do something which would sabotage my stand as well as the company's stand, because Indian judiciary is very burdened. Nobody wants to go there unless they are compelled to go there. So, I'd go, we'll sit with the founder, understand what is the plan. And if there is certainty that, within, say, the next 3 weeks, this covenant is getting rectified, fine. I mean, no lender takes any knee jerk reaction for that. So there is a certain cure period to rectify your breaches of covenants. And then, even if, for example, something fundamentally has changed with the company and you don't see any concrete plan, Then obviously there are other recourses of event of default, wherein you could, for example, you know, as we were discussing, sell the business to somebody else, or whatever essentially you have charge on, you can go and sell it to anybody, you know, to recover your money. Or you could drag the company to NCLT, which is the insolvency court, right? And then obviously, you know, there will be no further equity investment in the company, because the company is essentially uh, going into liquidation. And then the liquidator will decide what to sell, how much they can sell it for, and as per the waterfall, who will get what money, right? And typically in the waterfall, number one is stat dues, which is statutory dues. So if you have any TDS, any PF, any unpaid salary dues, all of that has to be settled. Then you have your financial creditors, which are the secured creditors. They get paid. After all financial creditors, then there will be operational creditors, which are your vendors, your say server bill, your rent bill, all of that. And then if anything is left, will it go to the equity shareholders? And in that equity shareholders, there is liquidation preference, which people sign in the SHA when they sign with the
The
equity holder.
shareholder agreement.
Yes. So as per that, the money gets distributed. So these are the, I think we went just too deep into event of default, but coming back to the documentation, these are a couple of main things in the facility agreement. And there is cure period, grace period. Lenders are always, want the company to succeed always. And then the other document is your warrant agreement, which is essentially what we were discussing. What is the exercise price, locked in price, and what is the tenor during which it can be exited. And the third would be your
But
deed of
one quick question:
hypothecation.
the exercise price is typically the last round valuation.
Yeah, yeah.
Okay.
It is typically the last round of valuation. If you've raised around, say, in the last 6 months or so, but if your round is very late, I mean, way back, say 1 year back, generally founders don't want to give that price. So they'll say, take it as a discount to my next round, which may be
Okay.
evident, may not be too evident, but it is a certain discount. It could be a monthly discount or a quarterly discount or a flat discount to the next round.
Okay.
So that is
So
your
a
second
monthly discount
agreement.
would be like, if my next round is after 6 months, then you get a 6%, like 1% per month, so 6%
Yeah,
discount per
something
month,
like that. All of
something
that
like
is
that. Okay.
a lot of negotiation. It could be
Hmm.
1%, it could be 1.5%. Sometimes people say that, don't take a monthly thing, just take a flat 20% to my next round. Depending on, obviously, they know best when they are entering the market, when do they feel the round will get completed. So, yeah. And the third document is the deed of hypothecation, which is essentially just it lists down the things on which the lender has a charge on. So current asset, fixed asset, your brand, IP, those kind of things are listed. And that is a document that gets filed with the Ministry of Corporate Affairs, MCA, on the website. That gets filed. uh, so that is a CHG 9 form, which is a charge form, which essentially publicly says that this lender has this charge on this company. Yeah. So these are the three
Okay.
documents essentially which one should be aware of. And once the documentation is signed, obviously there's a lot of negotiation. You'll have your lawyer, they'll have their lawyer. But once that's negotiated and signed, then we move to disbursement. So we will disburse the money after the documentations are signed. Yeah.
Your due
Then
diligence sounds
secretarial filing. Yeah.
your due diligence sounds more stringent than what a VC does, I guess. The amount of things that you do in your uh, underwriting slash due diligence.
Yeah, so I think VCs generally have to be more optimists, uh, and we have to be optimist if you have to be in this segment, but with a, I would say, slight realistic side also, because just because you know a company has done well in the recent past, I can't assume that, next year 4x, the year after that it'll be 8x. So if if I am not that optimistic and I have to, tone down my assumptions that whatever the company is doing, it'll probably do similar or slightly better. So we'll have to be prepared for all those things. And just as I said, we don't have any power law thing, so it's important that all my loans come back to me. Yeah.
Okay, understood. Okay, and then the money dispersal is also done in tranches typically.
Yeah, if for example we've given a larger sanction, as we were discussing, there are certain milestones post which the subsequent tranches are paid. It's fine. Sometimes it could be a single tranche, you know and that also happens.
What is more common?
I think tranched approach is more common
Okay.
because you've already underwritten the company. You want to sanction a particular amount. You don't want to get into the hassle of documentation for every tranche, but you're also sure of when do you want to give that second tranche or third tranche. Yeah,
Okay, understood. Understood.
yeah,
Is Stride an AIF?
yes. Stride is an AIF.
Okay. Give me like a little bit of context on the origin story of Stride, and maybe a little bit of your personal origin story also.
Sure. So Stride is founded by Ishpreet. Ishpreet is a career banker. He started it in late 2018 when he was coming out of his bank job. And he's worked across multiple Indian private banks and MNCs. And I had joined right when the first fund had, we just kind of, we were just about to do our first transaction. And so I've been with Stride since 2019, and grown within the system. So I joined as a principal, got promoted to a partner in the second fund, and then a managing partner in the third one. Led a lot of investments, done a lot of fundraising, so been involved with all the activities at the fund level, on the performance of the fund. Stride across the last 4 5 years has now become the largest venture debt provider. We have three funds in India, three INR funds, and across the three funds, we have $450 million in assets. And this $450 million is in about 135 portfolio companies that we have. We have been able to demonstrate industry leading returns, a very robust asset quality, and a very diversified portfolio of category leaders across the length and breadth of the startup ecosystem. We have some very, very high quality names. For the listeners, they should definitely visit our website and see the kind of companies that we have invested in. Uh, 40% of our portfolio is consumer, and it is because of the inherent requirement for working capital in those businesses. So whether it's beauty and personal care, fashion, jewelry, home decor, footwear, we have food and beverage, we have all those high quality companies. Then financial services is another big sector for us. And then of course there is EV, clean tech, B2B commerce, etc. So three funds, $450 million in assets, 135 portfolio companies. This is all in India. And now we have two global vehicles also, which we started last year. One is out of Gift City. We became the first credit managers to get the license in Gift City. And we became the first Indian fund managers to get the license in Abu Dhabi. So we want Abu Dhabi to be the global footprint for Stride, and whatever we have done and achieved in India, can we do it for Middle East, Southeast Asian countries as well? Because Middle East and Southeast Asia, venture debt as an asset class, is not as evolved, not as mature. So yeah, this is the Stride journey. With respect to my personal background, I've been working for about 14 years. So the last since 2019 I've been with Stride, but prior to that I was at Xander. Xander is a private equity fund. They also have a structured credit desk, through which they were doing basically lending to companies more in the brick and mortar mid market space. And prior to Xander, I was at HSBC in their investment banking vertical. So yeah.
Okay. 450 million deployed. Out of how much raised?
No,
Like,
450 million is the total raised.
okay,
450 million total raised. That is the corpus that we manage. And out of that 450 million, we would have deployed, yeah, 350 million we would have deployed. Three
okay,
fifty, 375 million we would have deployed. Yeah.
okay.
Yeah.
Does it operate the way a VC operates, that you call the funds when you want to deploy them from your limited partners, the investors?
Yes. Yes. You
Okay,
call the fund when you want to deploy them. But our deployment cycle is much faster. So if we have raised funds and we have typically a 4-year time frame during which we keep the money invested, but to our investors, we have to distribute quarterly coupons. And after 4 years, we have to distribute the initial capital as well, the principal component as well. So during the 4 years, typically during my first year or maybe first 15 months, we deploy the full capital. And then we are just churning the capital.
okay, okay, okay. Understood, understood. Is there ever a case where you've reached the end of the fund life of 4 years, but you're yet to get the money back? And what happens in that case then?
So fund one, we have been able to distribute the entire capital in entirety. That is the fund which 2019 vintage. We completed the fund commitment period. We've returned the full money. We're very happy with the performance. So that is done. Fund two, we still have 15 months left before we have to start returning the principal. So I hope that situation does not come. But yeah, it hasn't happened so far.
While deploying only, you would keep that in mind, that I will not have a
Yes,
tenure
yes.
which is longer than my repayment date of the fund.
Of course, we are very mindful of that, that the day I have to start returning my principal, my tenors have to be locked in accordingly.
Okay. How much did the investors get as a return on investment for Fund 1, the Fund 1 LPs?
So, Fund 1 for us, the gross return was 22%, and net, which is post your expenses, fees, etc., we are at 18% net to our investors. So, Akshay, I lost your voice.
Sorry, the 4%
Yeah.
is your income, that 22 minus 418, that 4 is your income essentially.
So basically, the management fee, the upfront one-time fee, all of that, and then there is a small percentage of carry. All of that subtracted is what gets distributed.
Okay, okay, okay. So the way Stride earns is through that difference between
Of course,
gross
yeah,
margin
yeah,
and what is distributed back to the investors.
yeah, yeah. So any fund typically earns through management fee, the upfront fee, and the carry component.
Okay, and like in a VC, the partners, the GPs are more like they have a profit share rather than a like a fixed salary, or at least the fixed salary is marginal compared to the profit share. Is it something similar here, that the partners are more like profit share partners rather than on salary?
No, so there is a salary, which may be, yeah, not a very handsome figure, but yes, definitely your remuneration has a component of carry, which is expected to be bigger. Yeah,
Okay, okay, understood. And do you uh, do you get to earn more if you generate higher returns, or is your earning
absolutely.
fixed? How is that
No,
calculated? What is the formula?
so the carry component is what will decide. The carry
What is
gets
carry? Just
distributed to, yeah. So carry is performance fee, right? So for example, if I had committed X percentage of return, but I have given you 1.5x. On that 0.5x of incremental return that I have over delivered, I have a certain profit share, which is generally anywhere between 10 to 20%. So that the fund keeps, and that is distributed to, say, the partners and other senior leadership team. And that gets negotiated once you're joining or at the beginning of the fund, that this much percentage of whatever profit the fund keeps will get distributed to these many people in this percentage ratio. Yeah.
okay, understood. What is the amount that you guarantee to your investors after which the
So
carry
we
kicks in?
have, yeah, so we have the highest hurdle in the industry. The amount that you, so to say, I'd not say guarantee because this is not like a fixed deposit, but below this, you can't take any performance fee as such. So 11% is the hurdle for us, and it's the highest compared to any other venture debt fund in India. And we've been able to distribute, as I said, 18% is the net distributed return. So it's way higher than what the hurdle is. Yeah.
Okay, understood. How did Street put together Fund One from like in terms of finding the investors? Because I'm guessing the key thing here is to find investors because the startup boom is very much here, and there would be a lot of potential candidates who could be lent to. But finding investors would be the tougher challenge.
So the trick is that first fund you keep smaller. Keep it definitely lesser than 500 crore. And that is just for you to demonstrate what you can do, right? It's also very important that the first set of investors that you have get some, and thankfully, nowadays there is SIDBI who really promotes new fund managers, and SIDBI was very helpful in our first fund. Our first fund was 350 crore, but a very big size of it, I'd say more than 20%, came through SIDBI. And so any government, I would say, belief solidifies the faith amongst other LPs also. Because SIDBI, of course, does a lot of diligence on the background, reference checks, what you have done in your previous experience, and all of that, right? And then, of course, there's a bunch of family offices, etc., that you raise for from. So I'd say the first important thing is keep the fund size below 500 crores in your first fund. You can also keep it 250 to 300 crores. I think there is nothing wrong with starting with a smaller fund size. It's important to get fully subscribed, and it's important to do a good job, which means that you should be very careful of your initial few investments. These have to be your ambassadors of the kind of credit quality or equity quality, depending on whether you're a debt fund manager or an equity fund manager. It's also very important to hire the right kind of team. And obviously, at the onset, you can't have a very big team. Even you have, say, 7 to 10 people, they should be of they should have that intensity, that hustle, to make sure that the fund does well. And I think once your first fund has done reasonably well, from the second fund onwards, you can increase your fund size, but remain true to your roots and just make sure that you're doing the same good job even with an increased fund size. As your fund size increases, you obviously take the help of distribution partners also, wealth managers. And if you have 3 4 good wealth managers, they'll also help uh, you know
To find
raising a lot of
investors.
capital for
Really.
you.
Okay.
Yes,
Okay.
yes,
Hmm.
yeah.
What percentage of your funds is raised from Indian investors or LPs?
So all the three domestic funds that we have, it's all domestic. I
Oh,
mean, barring
100%.
one or two
Wow.
percent, everything is domestic. Yes, yes.
Okay. Okay.
For obviously for our international footprint, it will be very different. But for all the three domestic funds that we have, it's all largely domestic.
Okay.
Yeah.
Is venture debt driven by the VC funding cycles? For example, like this, they say that it's funding winter. Does that also mean that the investors who invest in venture debt start pulling back? I mean, are these correlated?
So of course it's correlated, Akshay. And as I said, venture debt is a certain percentage of venture capital that gets deployed every year. If that venture capital, I'll just give you a stats around it. 2021, the venture capital was about $35 billion worth of investment in 1 year. Venture debt would have been, say, close to 800 million. No, sorry, it would be close to 600 million in 2021. In 2022, that venture capital fell to 25 billion, but venture debt still increased from the 600 to 800 million. And that increase happened because the venture debt as an asset class was underpenetrated and there was room for growth. Also, because the fact a lot of companies in 2021 had raised massive rounds of equity, which could add debt even in the subsequent year. But then in 2023, venture capital fell again from 25 to say 10, 11 million billion dollars. And with that $10 billion, venture debt is flat at 800 million or maybe a billion. That is the range. But what I want to say is that it cannot grow in silos. It is a correlated asset class, and it should be a correlated asset class because most of these companies are loss making. How can you keep giving them debt when they're not raising equity? So, definitely, the growth of venture debt as an asset class is dependent on the growth of venture capital as an asset class in terms of the annual deployment. At the same time, Akshay, this year there was massive demand for venture debt because many companies who earlier thought that, raising equity is super easy and every 6 months you can go in the market and raise equity and you can ask for any valuation and you will get it. They've
Right.
realized that equity is not cheap, right? And it's important to save your dilution. Otherwise, you raise equity, and by the time you reach Series D, you are reduced to single digit shareholding, which significantly impacts your capability to raise further round of equity and is a suboptimal outcome for the founder, for the existing shareholders, for the business, everything. So use debt for the right reasons in the right quantity from the beginning of your journey. Use it smartly as part of your capital structure. This year we had a lot of demand because people thought that they will raise debt to defer equity raise. But unfortunately, not a lot of that demand is serviceable because we also have to underwrite risk, protect our investors, right? So that's why the growth in venture debt hasn't been as much this year, even though the demand was much higher, and that's why it's a correlated asset class.
Do you have a investment thesis the way a VC fund has an investment thesis that we will fund companies who are operating in this space and with this kind of an approach? So does a venture debt also build a thesis, or you are neutral?
No, so we have thesis. We might not have a very, I would say, specific thesis. So I might not say that, I'm going after cross border payments and I'll look at every company in the cross border payment and all of that. But at a larger level, the thesis that we have is that we'll only invest in companies which are category leaders, which are backed by strong VC investors, which have positive unit economics, breaking even or profit on a CM2 level, not burning a lot of cash, well capitalized, have cash for more than, say, 9, 10 months sitting on the balance sheet, good ref check of founders. Those are the kind of filtering criteria that we will have. And the companies that fit those filtering criteria, then of course we'll diligence it in a very different way but a very comprehensive way. But we are not too fussed about that I want the next biggest space tech company. No, I'll probably not invest in a space tech unless it becomes mainstream. So my idea is not to find those moonshot companies which may become a hero or may not exist tomorrow. I will look at companies which are already the category leaders, and I'm comfortable that my debt will come back. They'll end up giving me some warrant upside as well.
Okay, okay, understood.
Yeah.
Tell me about Gift City. What is Gift City, and why did you decide to launch a fund for funding Gift City based companies?
So Gift City is government's endeavor to make it easy for international investors to invest in an Indian fund. And all of us know that how popular is, for example, Mauritius. All fund managers have a feeder fund there, and you raise capital there, and that fund eventually deploys out of India or anywhere else, right?
So I know it's popular, but I don't know why. Why is Mauritius popular for?
Taxation.
Okay.
Taxation. I'll tell you the benefits with Gift City and how it's trying to replicate what, say, other some of these feeder funds in corporation regions have been. What is the benefit essentially for Gift? So, sorry, two main things in Gift.
Uh,
Okay, so I'll just give you a example of why Gift City is an attractive jurisdiction and what are some of those benefits that it endeavors to give to the investors, which, say, jurisdictions like Mauritius had been giving. So, out of Gift, two main things: you can raise in dollar, deploy in dollar, return in dollar. My money is not getting converted to INR. A lot of international investors always have to worry about hedging cost, about depreciation. Their returns get impacted, a lot when the rupee depreciates. So I think that problem gets solved. You don't have to worry about all of these things. I can raise USD in gift and invest anywhere outside of India. The second thing is the withholding tax component. That today, when international investors invest in India, they have, every country has a DTAA kind of thing, right? Double tax avoiding avoidance treaty. So essentially, say if an investor has come from Dubai or from Singapore, I'm not sure of the tax brackets, but say, for example, the normal interest is taxed at the marginal tax rate in India as per the Indian taxation laws. If it's an international investor, the fund manager will still deduct tax at source, TDS, as per the DTAA norms with that country. So I might deduct 12.5% and give you the money. You may be in a region which has to pay zero tax. But now that 12.5% is blocked. And then you have to do a host of compliances and documentation to retrieve that. In Gift City, there is no withholding tax. You pay tax as per your home jurisdiction. The fund manager distributes it. We are not deducting any TDS. So these two things make it easy for international investors to invest in Gift City. And these two things are very powerful. Gift City is a step in the right direction. They have also made sure that there's a lot of single window clearance. There is office space. It's like an SEZ, special economic zone. A lot of ancillary value added services are available in Gift City. There are proper offices in Gift City. You have single window clearances. The approvals are faster. And then there are obviously these other benefits that we spoke about. So that was our attempt that if we want to take stride global, as in raise in dollar, deploy outside of India as well, can we start it from gift? Because that's a known territory, you know the benefits, and it solves your purpose. If I'm, incorporating a fund in Singapore and I'm doing the same thing, I might as well do it from Gift City.
Okay, understood. So Gift City, the goal is to raise there, but not to deploy in Gift City. The deployment could be in India or Middle East.
Yeah, deployment. No, you can't deploy in India. बिकॉज
Okay.
वहां से आप कहीं भी बाहर कर सकते हो डिप्लॉय. आई एम
Hmm.
टॉकिंग अबाउट डेट फंड्स. ओके,
Okay.
दिस मे
Okay.
नॉट बी ट्रू फॉर इक्विटी फंड्स,
Okay.
बट
Okay.
डेट फंड में आप डॉलर रेज करके कहीं भी डिप्लॉय कर सकते हो.
But not India.
Not India, because of the ECB norms. So for debt specifically, those ECB norms
What is
kick in,
ECB?
which is external commercial borrowing.
Okay. Okay. Okay.
And that is the reason आप देखोगे कि जो ग्लोबल एमएनसी इक्विटी फंड्स हैं, चाहे वो एक्सेल हो, सिकोया हो, वो मॉरिशस से भी पैसा डाल देंगे, वो यूएस से भी पैसा डाल सकते हैं, कोई ऐसा इशू नहीं है. बट डेट फंड्स में इंडिया में आप नहीं देखोगे कि यूएस डॉलर का डेट इंडिया में फ्लो कर रहा है.
Hmm.
You have to open a subsidiary outside of India to raise that debt. But you will not see a lot of global venture debt or generally debt funds directly investing in India, because then the ECB kicks in, external commercial borrowing, and that has a lot of caveats with respect to minimum tenor, interest rate, compliances. So while you can navigate all of that and probably still end up investing in India, but I'm just saying it's very complicated. So generally, you will not see USD debt funds investing directly in India.
Hmm. Okay, understood. So, Gift City and Middle East. uh, how would you raise funds for these two? Because so far your LPs have been in India, so you built a name and a brand and reputation
Yeah.
in India. You
Yeah.
have the network in India to raise. How will you do it for these funds?
So yeah, it's a learning process, Akshay. We are also figuring out. Obviously, we have a certain uh, playbook of sorts for India. We know what kind of families invest, or our existing LP base. You can reach out to them if they've had a good experience. They'll definitely be repeat investors in your subsequent funds and all of that. But of course, international fundraise for us is also new. So we are trying to see if we can get some good anchors out of Abu Dhabi. And the Middle East has a lot of big sovereign funds. Uh, we are in multiple conversations with those guys to get a solid anchor, and after which we can start approaching families and treasuries for whom this may be of interest.
Okay, understood. Uh, Help me understand what the Stride organization looks like. Like how many people doing what kind of roles?
So Stride Ventures, obviously there are three partners, and then we have directors and principals who are responsible for sourcing deals and leading those deals, as in being a part of the commercial negotiations and making sure that a deal goes through, presenting to the investment committee. Then there's a layer of associates and principal associates who do a lot of heavy lifting with respect to diligencing the credit assessment, documentation negotiation as well, and then analysts. So there are about 40 people in our organization. It's actually large, for a venture debt fund. And that is because a lot of our processes are extremely institutionalized. Up of these 40 people, about 25, 27 would be on the investment side. But then we have a finance and treasury team. We also have an investor relations team. We have a couple of people who are only looking at warrant exits, some people who are only looking at making sure that your security is perfected. There are a host of institutional things that is needed in a debt fund, and because your monitoring is on a monthly basis, and I have to be assured of early warning signals and everything, my monitoring has to be tight, and I have to have that kind of head count, to make sure. You will see a lot of VC funds having $1 billion in AUM with just 10 people. And that, kudos to them. But that cannot happen in a venture debt fund where I have so many companies to monitor on a monthly basis to make sure I'm getting everything. My documentation is watertight, my security is watertight, all of that. We have an internal legal team as well. So, yeah,
Okay.
that
My
is the
last
structure.
question to you: what do you love about your job?
I think it's been a very satisfying professional journey for me, right since the time I had joined Stride. First, because I got to see the entire all verticals of how a fund operates, right? Whether it's just with respect to fundraising, managing your treasury, managing your drag, which is how much capital is unutilized and you still have to bear interest for your LPs, that is drag. So how to manage that, make sure your deployments are doing well, your founder relationships are good, your sourcing network is strong, your VC relationships are good, you're also differentiating yourself for your founders. You don't want to be a transactional capital provider. You're also differentiating for your investor base. you know how are you making sure you're arranging for co-investment, and beyond all of that, also just making sure that the brand Stride upholds. So I think just the entire complexity of various verticals and the perspective it gives, that is number one. Second, you get to meet so many accomplished founders, so many inspirational people. The third thing is that you're not married to a particular sector, right? You get to take views and perspectives and build your own opinions around whatever is happening in India. It's actually a sample of how India is evolving. So I think it's all of this together, keeps you satisfied that you're meeting so many good people, doing so many different things. And yeah, I think all of that.
Amazing, amazing. Thank you so much for your time, Apurva. It was a real pleasure.
Thank you so much, Akshay. Thank you so much for having me on your podcast. I had a lovely time too.